All right, welcome everyone. We're doing a special weekend briefing because, well, some huge geopolitical news just broke out of the Middle East, and frankly, investors are on edge. So we're going to break down exactly what this means for your portfolio as we head into what's going to be a very critical week.
Okay, so here's our game plan. We're going to start with that initial shockwave and what it's telling us right now. Then we'll lay out the very strong case for a Red Monday sell-off. But then we'll flip the script and look at the contrarian argument for a Green Monday rally. After that, we'll pull back and look at history's playbook for these kinds of events, and we'll wrap it all up with a clear, actionable takeaway for you.
Let's just state the obvious right up front. Markets are in turmoil. That is the unavoidable feeling across the board this weekend, as everyone tries to figure out what just happened and, more importantly, what comes next.
So here's the situation as we know it. We have reports of a joint U.S.-Israel military strike against Iran. The very first market to react? Crypto, and it plunged immediately. A state of emergency has been declared in Israel, and now all eyes are on that stock market open come Monday morning.
So let's start right there with that immediate reaction. This is that weekend shockwave, and it gives us our first real clues about what investors are thinking and feeling. The very first thing that happens in a crisis like this is a behavior called de-risking. It's really just a gut instinct. It's when investors sell their high-risk, high-growth assets, think tech stocks, cryptocurrencies, and they move that cash into things that feel safe, like gold or the US dollar. It's a classic flight to safety.
And crypto, it gives us our first real-time data point. Because it trades 24/7, it really acts as our canary in the coal mine. And just look at the aftermath of the news. Bitcoin down almost 6%, Ethereum over 5%, and Solana got hit even harder, down more than 7%. This right here is de-risking in action.
So with that as the backdrop, let's build the case for what most analysts, and probably most of you, are expecting: a Red Monday.
The reason for this is actually pretty simple. If there's one thing financial markets hate more than anything else, it's uncertainty. A direct military confrontation like this is a classic black swan event, and it triggers that sell first, ask questions later mentality.
And you know what? We can actually measure this fear. This number, a 6.6% spike, that's the jump in the VIX, which you probably know as Wall Street's fear gauge. When the VIX starts getting up there like this, it is a flashing red light that traders are buckling up for some serious turbulence ahead.
And we already have some clues about Monday's open from the futures market. See, since futures trade over the weekend, they give us a kind of early verdict. And right now, both the S&P 500 and the Dow are pointing to a negative start to the week.
An event like this also triggers a really clear rotation of money between different sectors. We can pretty much expect capital to flow out of high-risk tech and travel stocks like airlines because they get hammered by rising fuel costs, and into defense stocks, for obvious reasons, and energy stocks on fears of supply disruptions in the Middle East.
Okay, so the evidence for a Red Monday seems pretty overwhelming, right? But hold on. Is a big sell-off really a sure thing? Let's challenge that assumption for a minute.
Let's actually look at the other side of the trade and see how this argument builds, the contrarian case for a Green Monday.
So the bull case really hinges on this classic market theory. Sell the rumor, buy the news. The logic goes like this. Fear and anxiety cause prices to fall before an event actually happens. But once that bad news is finally out in the open, the uncertainty is gone, and the market can actually rally in relief because the big, scary unknown has now become known.
And we actually have some evidence for this theory. The S&P 500 fell almost 0.5% on Friday. That was the day before the strike. This suggests that investors were already pre-selling this risk, basically pricing in the possibility that this exact scenario could happen. So what this really means is that Monday's direction probably boils down to one single variable: Iran's response. If we see a major retaliation like them hitting oil infrastructure, that's the trigger for a Red Monday panic. But if their response is seen as limited or just symbolic, we could absolutely see a relief rally as the market decides the worst-case scenario has been avoided.
So we've got two competing theories, right? Red versus green. How do we break the tie? Well, this is where we turn to history's playbook and just look at the cold, hard data. A really powerful recent example is the Iran-Israel conflict back in June of 2025. The pattern was incredibly clear. Day one, the market drops on the news. No surprise there. But then, it found a bottom in just 12 days after a pretty mild 4.6% dip. And get this, by day 18, it had already achieved a full V-shaped recovery.
And this V-shaped recovery, it isn't a one-off, not at all.
When you look at the data from multiple major geopolitical crises, Russia-Ukraine, 9/11, even back to the Gulf War, the pattern is remarkably consistent. Now, of course, every event is different, but we see the same story: an initial shock, a bottom found relatively quickly, and then a recovery. Market resilience is the powerful, dominant historical trend.
Okay, so what does all of this mean for you as an investor trying to navigate this? Let's distill it all down into one clear final takeaway.
Here's the most crucial point. While all the historical data suggests a recovery is not just possible but likely, Monday morning itself remains the danger zone. It's the very first time the stock market gets to react, and that initial session is where we're going to see the most emotional, knee-jerk selling.
So here is your playbook. Number 1, and this is the most important, don't panic sell. History shows again and again that selling into the initial shock is almost always a costly mistake for long-term investors. Number 2, Monday is for observation, not for action. Watch, see how things unfold. And number 3, for those of you with cash on the sidelines, look for bargains. Those buy-the-dip opportunities very often start to appear by Tuesday or Wednesday once that initial wave of panic is over.
And that really brings us to our final question for you to think about this weekend. In an age of what seems like constant uncertainty, the choice becomes very clear. Are you going to follow the panic, or are you going to follow the playbook?